Welcome to The Explainer. Today, we're unpacking a corporate narrative that is, frankly, kind of mind-blowing. It's a truly fascinating two-sided story. On one hand, you have this towering giant in the precious metals industry, literally billions in transactions. But on the other hand, you have a company that has faced intense scrutiny and multi-million-dollar penalties from state regulators. It's a total masterclass in corporate survival, legal restructuring, and market dynamics.
Okay, let's dive into this central paradox. How exactly does a company survive multi-million-dollar fraud settlements, go through a highly publicized bankruptcy, and somehow emerge on the other side seeing record demand? Not to mention maintaining near-perfect customer reviews and actually expanding its footprint. Well, that's the complex puzzle we're going to solve together today by looking straight at the hard data and the legal records.
So, to make sense of these contrasting realities, we'll map out our journey right now. We're going to hit 5 key areas. First, the precious metals pitch. Second, hidden fees and settlements. Third, Chapter 11 reorganization. Fourth, operational continuity. And finally, we'll look at the market today.
All right, starting off with Section 1, the precious metals pitch.
So, founded back in 1997 by investment professional Kevin Demerit, Lear Capital has been a fixture in the retail commodities market for well over 25 years. They basically built their entire business model on pitching physical assets, specifically gold and silver, to traditional retirement savers. If you listen to talk radio or watch cable news, you've definitely encountered their ads. They heavily urge everyday Americans to protect their hard-earned retirement funds by rolling them over into precious metals IRAs.
And this brilliantly illustrates the core conflict we're looking at. State regulators alleged these were deceptive, high-pressure practices aimed at getting people to liquidate their traditional savings. Meanwhile, Lear Capital touted a 25-year track record of trusted transactions, saying they were simply helping customers hedge against the very real threat of inflation. Both of these completely opposite narratives were operating at the exact same time.
Which brings us to Section 2, hidden fees and settlements.
A 33% commission, that was the smoking gun for regulators. Following a major investigation, New York state officials discovered that Lear Capital was taking these massive cuts on precious metal trades. Now, the issue wasn't necessarily that a fee existed, it was how it was disclosed. Regulators found that these hefty commissions were buried in tiny font, completely obscured by confusing industry jargon. Imagine rolling over your life savings, totally unaware that a full third of your money was instantly disappearing into commissions rather than actually buying you gold or silver.
The fallout from this was swift and it was severe. In 2022, New York Attorney General Letitia James spearheaded a massive lawsuit that culminated in a $6 million settlement. According to the state's filings, about 1,000 New York residents had been persuaded by Lear's advertisements, investing a staggering $43 million into these accounts. So the settlement was specifically designed to claw back funds and repay those residents who were misled by that hidden fee structure.
But the legal trouble definitely did not stop at the New York state line. As other states launched their own probes, a nationwide bankruptcy settlement was eventually reached. This created an additional $5.5 million fund designated specifically to distribute refunds to investors across the country who had bought precious metals from Lear Capital between 2016 and early 2022 and were hit by those undisclosed fees.
To really understand the gravity of how state watchdogs viewed this, just look at the statement from Troy Downing, the Montana State Auditor and Commissioner of Securities. He stated, quote, "These deceptive practices took thousands of dollars out of the pockets of hardworking Montanans." End quote. Regulators across multiple states shared this harsh stance. They made it their absolute mission to enforce consumer protection laws and hold the company financially accountable.
Let's move into Section 3, Chapter 11 reorganization.
So, the crucial point is that Lear filed for Chapter 11 reorganization. Let's demystify that jargon for a second. This is a strategic legal process that allows a business to keep operating completely normally while it restructures its debts. It's vastly different from a Chapter 7 liquidation, where a business is just totally shut down. Lear Capital did not go out of business. And the timeline here moved rapidly. In 2022, that $6 million New York settlement triggered the restructuring. By 2023, the federal bankruptcy court officially confirmed their plan, which included the $5.5 million national investor payout. And by early 2024, Lear Capital successfully emerged from Chapter 11. They had formally reorganized their financial structure to absorb these massive penalties and keep moving forward.
However, the bankruptcy courts and state regulators didn't just demand cash. They demanded real structural reform. As part of this reorganization, Lear was forced to adopt some strict new consumer protections. First, they were legally prohibited from misrepresenting their fees or claiming to be certified investment advisors. Second, they had to establish a 24-hour risk-free cancellation policy for future sales. And third, they were mandated to maintain a highly detailed, searchable database of all customer complaints going back at least 4 years.
Because of these mandates, Lear Capital now explicitly publishes its spread ranges, which run between 2% and 35%, right out in the open. Now, why does this matter for you as an everyday investor? Because it takes what was an opaque transaction and makes it completely transparent. Understanding the spread, the difference between the buy and sell price, is absolutely crucial to figuring out if a physical commodity investment can actually generate a profit for you after costs.
Section 4. Operational Continuity.
Now, what's really interesting about this slide is that the operational reality for the average customer was completely untouched by all this legal drama. Seriously, despite multi-million-dollar settlements, Lear maintained all its staff and inventory. For existing customers, their metals remained fully segregated and heavily insured at the Delaware Depository. Direct home deliveries continued without a single hitch, and most notably, according to corporate and legal records, not one single customer, vendor, or business partner incurred a monetary loss as a result of the Chapter 11 process itself.
And the metrics from everyday consumers are honestly a stark contrast to the fraud allegations. Look at this. Over 3,100 reviews on Trustpilot, averaging 4.7 stars, a 4.8 on Consumer Affairs, an A+ rating from the Better Business Bureau. These positive metrics held incredibly strong during the exact same era the company was navigating bankruptcy and paying millions in fines.
Furthermore, the company strategically retained its prominent public endorsements to project stability. By holding on to and even recently renewing partnerships with highly visible media figures like Judge Andrew Napolitano, Lear Capital basically signaled to its target demographic that it was business as usual. For an audience that trusts these specific figures, seeing them stick by the company post-reorganization was a huge validator.
Let's move to and see how this builds into our final section, the market today.
So why does a company like this continue to thrive despite such a rocky regulatory history? It really comes down to market potential. A recent Bankrate survey found that only 9% of Americans identify precious metals as their preferred long-term investment. Now, while that might sound super low, to a company like Lear, that signifies a massive, completely untapped market of retail investors who haven't yet diversified into physical assets.
And the current macroeconomic environment, it's serving as the ultimate tailwind. Just look at the trajectory of gold prices in the first half of 2025. Driven by persistent inflation, geopolitical tensions, and dollar weakness, gold started the year at $2,650 an ounce. By March, it shattered the $3,000 barrier. By April, it surged past $3,400. That is a staggering 40% year-over-year jump. When the product you sell is breaking all-time global records, consumer demand is naturally going to follow.
Kevin DeMeritt, the founder of Lear Capital, recently summed up the core argument that keeps their phones ringing off the hook. He said, quote, "Gold has a largely inverse relationship to stocks, often used as an inflationary hedge. Every year, we're losing value, so we need something to offset that." End quote. Regardless of the company's past legal entanglements, this fundamental macroeconomic thesis that physical gold acts as a shield when currency weakens continues to resonate deeply with a huge segment of American savers. Which brings us to a final thought for you to consider. We've looked at the multi-million-dollar fraud settlements, and we've also looked at the pristine operational continuity and surging market demand. So I leave you with this. When planning your own financial future, how do you weigh a company's history of regulatory crackdowns against their current market opportunities and mandated operational transparency? It's a really complex balance of risk and reward that defines modern retail investing. Thanks for joining me on this explainer, and keep learning.